10 financial rules of thumb you don't have to follow. Financial plans can be overwhelming to conceptualize, create, and cultivate. So to help make sense of them, most people turn to goal-setting principles or easy rules of thumb. But these frameworks can have their limitations. A rule of thumb provides a rough outline of how to think about something, but it isn't a silver bullet. Your life and situation are unique, and so are the practices that are best suited for them. The idea of goals could also be reframed. You know your financial goals. Maybe one is buying a house or paying for a child's education. But think about those goals as more of a means than an end. Why do you want to buy a house? It's not just so you can say you're a homeowner. It's because you want stability, security, and a place to raise your family. By viewing your financial goals as a way to manifest your values, you can better identify what you need to do to achieve them. Use this guide to unpack which rules of thumb apply to you and which ones you can ignore. Rule of thumb number 1. Delay Social Security as long as possible. What to know? You can start collecting Social Security at 62. The age thresholds for higher Social Security payouts vary depending on the year you were born. If you were born in 1960 or later, you can get a higher monthly check if you start at age 67, and an even higher one if you wait until 70. Consider what delaying Social Security would mean for other aspects of your life. Would working until you're 70 mean sacrificing your personal goals? When to follow it? 1. You're currently working and earning the most you've ever been. Since your Social Security payout is based on your lifetime average income, working a couple more years at a higher salary can help increase your monthly payment. 2. The delay will be a good motivator. Consider if this timeline will help motivate you to save more in your other retirement accounts or to work longer. When to break it? 1. You don't have a long life expectancy. The added lifetime benefit of delaying Social Security to age 70 is clear if you live to 90, but not if you live to be 75. Though no one knows how long they'll live, even a rough approximation can be helpful for increasing your lifetime benefit. 2. It's not feasible to work to 70 and you don't have other retirement assets available. You may need to pull other financial levers, but your Social Security payout can still be a key part of an early retirement plan. 3. Your spouse earns more than you. Use your lower Social Security paycheck to tide yourselves over, and delay collecting the higher-earning spouse's Social Security. Maximizing the higher amount will increase the eventual benefit for the couple. Rule of thumb number 2. Never take a loan from your 401k. What to know? Withdrawing funds from your 401k before retirement age, 59.5, incurs a 10% penalty, unless it's an emergency withdrawal. And if you lose or leave your job, you'll have to repay the loan in a short period of time, typically 60 or 90 days, or the remaining balance will be subject to the 10% penalty and standard income taxes. Understand how each of your accounts supports your goals. Ensure that you're putting funds toward their intended purpose and only deviate when it's absolutely needed. When to follow it? 1. Your basic needs are covered. A 401k loan is not meant to afford a higher mortgage payment or fund a vacation. Withdrawals mean you'll have less saved for the future and miss out on compounding. 2. You have the means to create an emergency fund. Consider a savings account or a money market fund for your emergency fund, which is the gold standard for covering unexpected expenses. When to break it? 1. You need cash for a specific, one-time need. When necessary, your 401k can provide a one-time cash infusion to fund an expense like rent or a mortgage payment to prevent eviction or foreclosure. 2. Your only other option is a loan with a third party. Though you'll carry the burden of interest on the 401k loan, you'll pay it into your account rather than a bank. 3. You're carrying high-interest credit card debt. The average credit card plan's APR is 15.78%. So you may choose to absorb your 401k loan's penalty and rid yourself of the double-digit credit card interest, especially since you're paying the interest on the 401k loan to yourself. Rule of thumb number 3. Prioritize paying down your mortgage. What to know? Mortgage debt is most Americans' biggest single form of debt, with student loans in a distant second. For many, Paying off that enormous debt and owning a home outright is an important source of comfort. Think about how meaningful the security of homeownership is to your personal goals. When to follow it. 1. You're close to retirement. If you have more conservative investments, the returns you'd see on new contributions probably won't exceed your mortgage rate, and you'd more effectively reduce your fixed expenses by paying off your home. 2. You have private mortgage insurance. This is typically required for borrowers with less than 20% equity in their homes, and most individuals would benefit from paying down their mortgage enough to eliminate the extra expense. When to break it. 1. Your mortgage interest rate is lower than bond and cash yields. If you have an older home loan with a low interest rate, today's bond and cash yields could exceed the return you'd earn from mortgage paydown. 2. You have longer until retirement. Though stock returns are never guaranteed, history suggests that stock market investing will outperform mortgage rates over several decades. 3. Carrying a mortgage would be a boon to your taxes. Factor in all the tax implications. Though you're likely getting a tax break from carrying your mortgage, recent changes to the tax code limit the power of this benefit. Still, doing so can help your overall tax situation if, for example, it allows you to make higher pre-tax contributions to your 401k. Rule of thumb number 4. Prioritize diversification in investing. What to know? It makes sense to have a plan for navigating different market environments. For example, Morningstar portfolio specialist Amy Arnott explains, large cap stocks perform best during economic growth and bonds during low inflation. But diversification should help you feel like your goals are within reach, not make you worry about missing every opportunity. When to follow it. 1. You're investing over a shorter period. Diversification is the best way to ensure that even if certain asset classes experience losses that may not recover within your time horizon, you'll still come out ahead. 2. You're only investing in single stocks. You can reduce stock-specific risk by investing in equity funds that own a basket of securities, but it's even better to use funds that own a variety of asset classes to make up for potential net losses in the stock market. When to break it. 1. You've been taking the same approach to diversification for a while. Correlations between asset classes change, and one mix of investments won't behave the same in every market environment. 2. You're adding asset classes that don't serve another purpose. Investments like real estate might seem great because they don't move in tandem with the broader markets. But their lows can be major, and that can be hard to stick with. 3. It's getting too complicated. Morningstar research shows that 87% of the time, a 60/40 portfolio has better risk-adjusted returns than a portfolio with exposure to 11 asset classes. Diversification is important, but you don't necessarily need an array of niche asset classes to see its benefits.
Friends, thanks for watching. Please subscribe my channel for more videos.